Check, check. 1 2 1 2 1 2. Check 1 2. Hey, what's up, everybody? RPM with you here. Trader Spotlight Live, DayTraderRadio.com. It is Monday, May 21st, 2012. It's right here just a few minutes after 9 p.m. Eastern Standard Time. I want to welcome everybody in the Day Trading Radio Premium chat room. I see a lot of regulars in there tonight. Say hello to you guys. Appreciate you joining us. And tonight's special guest, Futures Trader 71, we're going to refer to him as FT. Going to get started with that in just a minute. Just want to mention to you guys that you can send me a private message if you want me to relay a question to FT, and we can do it that way. He's not in the chat room tonight, but he's showing he's in the chat room, and that's actually his office, in the chat room from the office, but he does not have the chat room up, so he won't be able to see if you send him any questions. But if you do type FT71 in there, I'll see the orange and black icon, and I can relay those questions to him. But you can also send me a private message, and we'll get those questions over to him. So with that, we're going to go ahead and get started. And let me welcome FT71 and get his audio up here. FT, you with me?
Yeah, I am.
All right, welcome, man. Good to have you.
Thanks for having me.
Yeah,
Thanks
no
for
problem.
being here.
So I thought what we would do tonight, first of all, let me just make sure everybody can hear FT okay. Just get a little audio check in the chat room there, make sure.
Test, test.
Yeah, it's okay. Everything, I think, is going to be fine. Why don't you go ahead and tell us all about FT?
So I've been trading futures for about 10 years, traded equities 2 years before that on a professional basis. Of course, traded equities through college and so on for about 6 years or so before that, but, in between classes and, out of my cubicle and so forth at work. But I decided to quit what I was doing. I was an engineer, a construction manager, and decided to quit and join a group of guys down in Florida known as the SOS Bandits, and started trading with them. And it was a very interesting process. It was a painful learning curve. And then when 2001, 9/11 hit, a lot of things changed. The equities market went decimal, and then since we used the SOS system, a small order entry system to trade, they added some fees and stuff that just made it very difficult to scalp those markets. So I found an opportunity through a friend in Chicago where I could join a prop trading shop. And prop stands for proprietary. It means that you would be given an account, and somebody else puts up the money, the shop puts up the money, and you trade their account. They risk the losses, and then when you make, if you make money, eventually, hopefully, you get a cut of the profits. And that's what prop trading is, and it's a professional environment. In fact, I worked right out of the Chicago Board of Trade until about January of last year when I moved my office into Vancar trading. So that's my background, like a very large overview. 2003, late 2003, I started my own prop shop and started backing traders, actually the traders that had taught me how to trade really at the prop shop I was at in Chicago. I started to back them out of that arrangement, and I became a prop shop owner. Excuse me. Became a prop shop owner and just loved it because I didn't like trading on my own, even though I was still in the board of trade and trading out of Advantage Futures at the time when they first, the very beginning of them opening up. I was one of their earlier customers. So I just surrounded myself with friends and then just started to back traders because I loved to trade in a community, in a professional environment. And I like the process of just taking someone who had never traded, does not have a clue what a trade looks like, and to walk them through the process of changing the way they see things, changing their attitude, and then learning how to trade. And then ultimately, the goal is for them to be profitable, so that I can make money, obviously, as a prop shop owner by taking a percentage of their profits, and just kept doing that until I came online and started this Twitter thing back in November of '09. And it was one of my first exposures to what we call the retail trading environment, just the general public, trading public. And I just noticed that there was just an awful lot of misinformation, disinformation, and I just started to kind of offer a view into what I was doing, my approach to the market, just to help people out. And I've been blessed in that process, in that I just had no goal for what I wanted to do with it. But all of a sudden, I'm learning about what's out there, and I'm learning about how people are approaching the market differently than I am. And most of all, I learned how much of a difficult time the public has with figuring out what's real, what's not, what works, what doesn't. And it just seemed like there was a whole lot of people who were taking advantage of that. So I decided to just do these random chats on these free services online, and all of a sudden I would have 300-400 people attending and asking questions and kind of looking over my shoulder, like, why did you trade here? Why did you trade there? And I would post my trades live. I would post my homework in the morning. I would tell them when I'm stalking the trade. I would tell them what entry I had in real time and how I managed the exit or how I managed getting stopped out. And it just caught fire. Immediately, just people started piling on and following what I was doing. And it required a website and a blog so that I didn't have to repeat myself all the time. So I created www.futurestrader71.com. And a guy helped me create the website just as a volunteer. And then after a while, that became too much. I started having 6,000-7,000 followers with questions. So what I did is I created a glossary and a chat archive, and I would just point people to it. And then eventually I decided this was too much. It was too distracting. It was too time consuming as much as I wanted to help people. So I decided I was either going to quit or change into a pay model where my time was being compensated for, and I'd give it a lot more focus, right? So instead, the idea came up that maybe I could package basics into a webinar series, and then the proceeds that came from that would go to my charity, which was started in January of 2008, and then that would help the charity with the grants with the money that it was trying to raise, and then I would and people would pay for the information or the knowledge, and it was like super massively underpriced. And that brought in even more people. It just became a much more, I think that doing that caused people to see this as a more genuine effort, so to speak. And that's basically the background. And then that's still in progress, still out there.
Right. FT, do you want to go ahead and just speak about Vancar and relationship with that, and go ahead and get that out of the way? And
yeah, so when you try to help people, you find out what their issues are, and I'll be frank with you, whether you're trading stocks, options, futures, baseball cards, it doesn't matter. Anything that has a monetary value and some quantity that goes with it. it's all an auction market, and so people have the same problem. So you could be trading stocks. It doesn't matter. To me, you're just another trader with a certain amount of baggage based on your beliefs. And what was going on is I was helping people, spending a lot of time on the phone and emails and online, and but then I wouldn't know what they were doing. So I would tell someone, here's what you got to do tomorrow. You got to do this homework, and then you come in and you need to control your risk and so forth. And I actually have trader interventions on my website that you can listen to. Just go to www.futurestrader71.com, go on to resources to the chat archive, and you'll see these chats that are trader interventions. And what I came to realize is no matter what I do, people can't help themselves when it comes to risk, when it comes to just normal human behavior. The best way to make an impact, and that's what I was trying to do, is make an impact on these people's lives. The best way to make an impact is to actually see and be able to control what, on a best effort basis, what they were doing. And the only path for that was to go through brokerage, because as your broker, I can see what you're doing. I can see what risk limits you have. I can control how much risk you can take. I can see the results. And what we did is we took it a step further. So I teamed up with Anthony Giacomin, who used to be a lot in the room and is, hopefully coming back. I teamed up with him as a partner to put this brokerage together. And our approach is to change the way the industry works with the trader. So I'm taking my prop experience, and I have an extremely high success rate with prop, and try to provide that to our clients. So that's what makes Vanguard different. There is no other broker that does this. There's no other broker that has the resources, the expertise, the technology to be able to do it. And so what we do is we bring people in. We look at their account size. We look at their risk, and we give them the appropriate amount of risk while they learn. And we can always leverage up. And then we monitor what they do. We have alarms set that say, when you cross a certain threshold in losses, I will intervene. I can hit you through the platform and tell you that you're trading with your monkey. You're not trading with a clear mind, and stop people from blowing up. I mean, if you're losing 10% of your account, you're going to get a call from Anthony or I. And in most cases, unless the world's falling apart and too many people are losing that much money, your normal broker, your everyday broker, your current broker, account of $1,000 or $500, and couldn't care less or if you blew yourself out. Well, if you're not healthy as a trader, as a client, then we're not healthy as a brokerage, and the industry's not healthy as a whole. And that's the difference. Whoa, I lost you there. Did you lose my screen, Paul?
Yes, I did. But I think we're still live on the air. Let me make sure everybody can still hear us.
Okay.
Actually, I still have your screen. You lost your connection to your work.
Okay.
Yep.
Can you just shut off my screen to the public for a minute, because I gotta log in again.
Actually, nobody's seeing anything you've had up on the screen yet, but I'm watching it on another
good.
screen. Yeah, we're good.
Okay, good.
I think it might be your outgoing connection, but
yes, it is. So, because I'm doing this from home, so that's what I have to say about the brokerage. I'm not a broker. I am a registered broker, but I'm really a trader, and what I do is trade all day and monitor clients' activities. And then if they need it, I'll give them exercises they do to handle all kinds of stuff, mostly fear-based actions where they do their homework, they know their levels, and then they freak out when they put the trade on. Yep. They're able to take a 2-point stop loss, but their best winner is 2 ticks. Those odds are not in your favor when you're trading like that. So I've spent the last 10 years working with traders and my own issues, and I understand the human mind very well. I'm not a therapist. I'm not a psychologist. I just know a whole heck of a lot about what it takes to, you know, to bring on some consistency. Success is never guaranteed. You know, past performance is not indicative of future results, and there is a risk to trading. But you know, they have a better chance with us, I believe, than what I've seen so far.
Well, you know, the whole thing about, you know, the been there, done that. You know, I think that that's a lot. You know, that says a lot because, you know, it's like you're a trader first. You know, which it's amazing. You know, for the, you know, coming to you guys as the broker, you happen to be a broker, but you're also a trader. So, and you've been there, done that. You know, so many other firms. You know, that there's probably a lot of people that with some of the bigger firms that you would talk to as a customer, and the reps on the phone have never placed a trade in their life, or if they have, it's, you know, very limited.
That's true.
You know?
That's true. Try calling TradeStation or Thinkorswim or Interactive Brokers and say, "Oh my God, I'm having my worst day ever. What do you suggest?" You know,
Right.
if you get that is if after 20 minutes of waiting you get somebody on the line. If you're lucky, you know, for me, trading comes first. It's a passion. I could talk about trading till I'm blue in the face. It's something that I love. And what I'm trying to do is do something completely different, something that it doesn't guarantee success. You can never guarantee success, but it's something that brings you a little bit closer, at least. At least it's a very, very good shot, so to speak, at getting closer to what you want to be.
Yeah, you know, if you guys can help people make money, it keeps your customer around for a long time. You help them become successful trader. It's a win-win. You know, I mean, I think that's great also for the customer. I mean, amazing to have a broker that, yeah, that backs you up, answers questions when you need help, and takes a look and a peek at your account, and you know, you can make suggestions or see what people are doing wrong, or whatever, that hands-on type of thing. I think a lot of people would appreciate that, especially as new traders, people that are just starting out on the futures. I would think that would be extremely beneficial. I know it would have been extremely beneficial to me. You know, it would have kept me from blowing through 3 accounts. At least, you know, the broker wouldn't have just laughed at me. You know.
Well, I mean, a lot of people don't even know what rollover is. They don't even know which contract is the front month. They don't know when the last trading day of a given contract is. They don't understand leverage. They don't understand the extent to which leverage is used in the, you know, in futures. These are important things to understand. It's a lot like, you know, wanting to be a pilot, going out, getting an airplane, but not understanding aerodynamics, not understanding at what speed that airplane would stall, for example. That would be a key thing to know, right?
Yeah.
I mean, what speed do you have to maintain in order for the airplane not to stall? So, you know, giving you a nice platform with all these colors and blinking numbers and stuff, that's the easy part. The hard part for most people is not the setups. I don't talk about setups. Setups are very individual thing. It's like trying to, you know, it's like the shoe has to fit your foot. But the issue in making or losing money in trading is your mind. It is you. I always say the worst obstacle to your success as a trader is you, is in between your ears. And there's, you know, I could talk about that for a while, but and that's where that's the hard part. Like when I back someone, when I back a trader, when I used to back traders, the hard part was getting them to just listen, to just do what you tell them to do. And that's where discipline is key. That's where, so having the best, you know, I could sit here and tell you exactly how to enter and exactly how to exit a trade. But when that setup shows up, even if I turn it into a green and a red light, green to go long and a red to go short, even if I put that on your screen, most people won't take the trade, you know, because there's so much that stands in the way. What happens if you take 3 signals and all 3 of them got you a stop? Well, you take the 4th. How about the 5th? And when you get deep into how it works, what trading's about, you'll start to realize, you'll start to realize that it's not about the last trade. It's not about, um, you know, making money immediately. It's about the long haul. And so if you look at the long haul, you're talking about being well funded. You're talking about understanding risk and keeping to your risk. The worst thing you can ever do is to go ahead, put on a trade, and lose 10% of your account. It's better for you to lose 10% in 1.5% increments than it is to lose 10% because you're just deer in a headlight, couldn't click the button, couldn't accept and book the trade. You just couldn't. You didn't have the heart to actually close the trade and book the loss because you were hoping that it would come back so you can scratch it. That's the worst thing you can do. And so there are exercises that you can do to instill that, because knowing something intellectually, and this is key here, what I'm about to say, knowing something intellectually is a world of difference between that and knowing it by experience. So knowing how to, drive a car by reading a book on it or getting on Wikipedia and figuring it out is a whole world of difference between that and getting in a car, turning the ignition, and figuring out what pedal you need to press to get the car to go or stop. And so, people are very good at the intellectual part. They'll buy that book. They'll, attend this course. They will pay for the signal, and they'll pay for that indicator. But ultimately, what gets in the way is your belief that a loss takes away from you as a trader and a win makes you the trader that you are. And that's, any professional who's been in the business long enough will tell you that that's not it. The key to trading is going from the nitty-gritty technical stuff that people focus on, like what setup do I have? Do I have a gold setup that I can take overnight that would make me, $600 or whatever? That's not the nuts and bolts. The nuts and bolts are, can I manage my account enough so that I can take a whole bunch of trades to allow my mind to wrap itself around the idea that I have to lose money, I have to take a risk in order to have a chance, just a chance at making money. And that's what your stop is. Your stop is, like in poker, it's the ante, like it's the minimum. You got to put that down to get your cards. And so what you're doing is you're going out there and you're paying up your stop potentially in order to find out if this trade will work. And what most people do is they get in there, they have no clue how much they're willing to pay up in order to see if the market agrees with their position or their bias or whatever for that particular trade. And when the market starts paying them, they quickly close the trade. But the fact is, you've put your chips on the table. So if you're risking, in the S&P, for example, if you're risking 2 points and the market goes against you a point and then goes back to your entry, then goes against you a 1.5, then goes back to your entry, and then you close the trade when you originally had, decided that your homework said risk 2 points to get 4. You just took all that risk, but most people will close the trade for a tick loss or scratch it, or yet they may take 2 ticks in their direction because they took a little bit of heat. The market goes in their direction 2 ticks, and they close the trade for 2 ticks of profit. But their exposure is like 2 points. How many 2-point losses do you have to? How many 2-tick winners do you have to? Do you have to have plus commissions to make up for that 2-point loss when you got stopped out? The math doesn't add up. You'd have to have greater than 90% accuracy or win rate to make up for those trades. So it's about a huge data set. It's about allowing yourself, trading is about allowing yourself enough chances so that you can experience each and every setup and each and every market condition, so that you can allow the process of trading to move from the logical mind, which can sit there and justify long or short at any given price, and move that to your intuitive mind where you're able to compute things without even knowing it, you know? And so people don't get to experience that. Most people, or a lot of people, don't get to experience that because one, they're undercapitalized, two, they're risking too much, three, they don't have any plan. They don't have any plan. They don't know what to do when they've taken 3 losses in a row. They don't have a daily loss limit. Those kinds of things are what differentiates any guy who's trading or girl trading stocks, futures, options. That's what differentiates the people who last and make money eventually, hopefully, and those who end up burning out, burning through their cash, then having to go get a job so they can create, generate enough money to deposit into their account so they can continue to trade. And even then, there's no guidance. There's nothing that tells them, hey, this is what you're doing wrong. And that's the difference between what I'm trying to build with the brokerage versus what everybody else is doing. Everybody's happy to take your money and give you, a commission and get you to trade. But we're more concerned with getting you to think about what you're doing,
Good stuff, man. Yeah, I'm reading the chat room here, and everyone in there or a lot of people in there are convinced that you have access to their accounts already. Because,
what do you mean as far as?
Because you're describing everybody in there, all the.
Oh, trust me. Between my prop guys, and I've been through 18 of them, 17 did really well, finished out their contracts. And those guys, which was intense. When I back a guy, I'm like, my livelihood depends on their success. Yep. So I am on their head. Between that and probably a few thousand people, a couple thousand people that I've tried to help out over the last few years, we're all the same. We all have the same demons. We all have the same issues. Most of us trade with little to no confidence, emotional capital, and most of us act on impulse despite the hundreds of hours of homework we spend every week trying to do, prepare ourselves for the game. Like a lot of people actually believe, and this may seem funny, but a lot of people actually believe that somehow, let's say, one of the levels I had today was 14 evens in the SM. So I go through and I do all this homework. A lot of people will, I share my homework with our clients and so forth, and I post it on Twitter. And most people will know that 14 is an area that the market might pause or turn. The first level is 875, and it's that morning high right there. Well, you don't have my screen up, but it was the morning high, 875. Most people know that that's the level, right? They've done the homework. They did it in a calm state. They did it in a state of detachment. And then they mark it on their chart. And then the market opens, and then the level comes. The market starts trading towards that level where they said they would do, they would trade. All of a sudden, they are smarter. Because now they're trading, they start to act different than what they said they would do when they did their homework. Somehow people believe that once I'm in a trade, I am smarter and I'm able to manage this trade better just because I'm in it. The fact is, once the trade comes, once that 875 level or 14 level comes, you should have no thought. There should be no thought. It's time to execute. You've already done the homework. You've already determined that that's an area you're going to play. You need to play that area because it's an edge. You have to play your edges. And edges might lose one after the other. But in the long term, in the bigger picture, as long as you keep your risk low and you manage your risk, your edge should show up. And so people get in a trade and all of a sudden they're like, oh, well, it's acting this way. I better get out. So they take their 2-tick winner, or they take a tick loss or 2-tick loss immediately after they enter because somehow they feel like they've gotten smarter once the trade is on. Once the trade is on, look at yourself as if you're a drunk driver. You think you can drive. You think you're fine. Yeah, give me the keys. I'm fine. Yeah, look at me. This is nothing. I can drive. But the fact is, You can't drive. And when you're in the middle of a trade, it's not time to think, it's time to execute. The best analogy to this process is a being a fighter pilot. When you're out there in the middle of war and you're engaging the enemy, there's a briefing where you know where the enemy is, what weapons you have, how you're armed, what airplane you're flying, with the capabilities of that airplane, all these technical things. But when you engage the enemy, are you looking at the manual? Are you looking at the map? Are you thinking about what you can and cannot do? No, you're executing. Trading is the same. It's a high performance sport. It's a creative sport, but it's a high performance sport. You can't do a lot of thinking while you're trading. If you find yourself doing a lot of analysis and a lot of thinking while you're trading, you are trading out of fear. And hey, you can decide not to believe me. You can decide to test it for yourself. But I've been through enough people and enough problems myself learning this to tell you that that's the ultimate, in the end, that's the conclusion you're going to get to. So I can sit here and talk about setups and how I trade and all this stuff, but I can tell you that speaking of setups and coming on and telling you what I did today, what I'm going to do tomorrow, isn't going to be as important in this discussion as telling you that your issues are your inability to believe in the homework that you've done or in the way you trade, probably because you don't have a plan for it.
Yeah, I just closed down the team viewer session. Your audio was getting a little bit choppy. I think maybe we really should just keep this to the what you've been talking about, because I want this to be on YouTube, and if we start talking levels or what's going to happen tomorrow and all that stuff, may be totally irrelevant to 2 weeks down the road when people are still watching this spotlight video.
It's true.
This is good stuff, man. I do have some general questions in the room here. If you want to take, if you're ready to take a few. Here's one from Average White Boy. He says, how do you handle news that comes out while you're in trades?
Good question. I know, okay, there are two types of news. There's planned news, like tomorrow's 9 o'clock central numbers, the home numbers. There's that news. Then there's the Greek craziness or Spanish craziness. For the planned news, I will not take a trade before a news event if I cannot get my first scale. So I go all in and scale out. If I have confidence in an area, I would scale in and scale out. But I'm always scaling because my number one priority is to lay off risk. If I cannot get the first scale before the news gets there, so I've only got a couple minutes, the market's dead, anticipating the news, I won't put the trade on. If I'm already in a trade, I will not close it based on the fact that there's a number coming or there's some news expected. I just put a hard stop in, and I just let it do what it's got to do. And then as far as unexpected news, the only thing that can protect me with my unexpected news is having a solid trading platform. I mean, that's key. If your platform goes down twice a week and you don't trust it, or you don't trust your data feed and so forth, I mean, I hate to say it, but you're screwed. I mean, that's why we have the platform that we have. It's been solid. It has not gone down. It's as solid as my X-Trader was, which I canceled once I joined Vancar. It's as solid as CTS, which is my backup platform. And so that's one thing. Two, your infrastructure, your internet connection, all that stuff has to be pretty solid. You're in the business of trading. If you're serious about trading, this is where your money needs to go. It needs to go into the tools you use, the information you buy, and the infrastructure you trade on. And I know RPM covers that stuff, has covered that stuff in the past, right?
Yeah, we have a lot of members, Day Trading Radio members, and I've dealt with a lot of people over about a 3.5 year period of time, and just diagnosing their internet connectivity problems, trying to help them out. And I can tell you this, I'd rather have a slow, stable internet connection than one that's sold as being super fast. It's up and down all the time.
Yeah, like a wireless connection or something like that.
Yeah, yep, exactly.
Yeah.
And a lot of cable providers, they offer these 20 megabit links and stuff, but the thing, 8 o'clock, 9 o'clock at night, it's out for 5 minutes at a time, the whole neighborhood.
Yeah, it's a shared pipeline is basically what it is.
It's oversold, and they really trying to, push too much down at DSL. If you can get a good quality DSL line, if your cable is not very stable, and you've had cable, switch over to DSL and try to get a 1 or 2 or 3 megabit DSL line, because usually they're very stable. That's what I use here. FiOS is usually really good, except for some areas of the country. Verizon's FiOS is kind of flaky, but I would overwhelmingly, I would say that stable connection, trouble-free connection, slower one will do you better than one that's that's just 20 megabits of speed. It does good if it's down off and on, off and on, off and on. So
Absolutely. For home-based trading, I use I use cable for my data, for my charts, my chat, all that stuff because of the bandwidth. But I've always, if unless I really can't, I've always gone with DSL because DSL has a consistent latency, whereas cable is like your water line outside. It's a big pipe, and the more people that tap into it, the less pressure you get at your house.
Right.
DSL is a consistent pipe, and the latency is very consistent on DSL. But to answer that person's question, the thing that saves me the most from unexpected news is my daily loss limit. Once I hit my daily loss limit, my risk plan has several levels that prevent me from hitting my daily loss limit, because it's a fair amount of money that I'd have to make up. But once I hit it, it's done. It's over. And that's what keeps me out of trouble. There are days, 1 or 2 days a month where I just can't get anything going. And if there's a person in this that or you're following or is in the room or whatever that tells you that they don't have at least 1 or 2 days a month where they're just completely out of whack, then I challenge their legitimacy as far as the trading goes, and that's what protects me. My risk plan tells me a lot of things. It tells me what sizing I should use, tells me how much leverage I'm going to use. It tells me how many stabs I can take for a particular setup before I have to stop. It tells me how much I can risk per trade, and it tells me how much I can lose per day, and it also tells me if I'm 50% of that. Let's say my daily loss limit is, let's use a round figure, $1,000. I have to do things when I approach $500 down. I have to cut my size in half. If I'm down $750, I have to cut my size even more. Now, if you're trading a 1 or 2 lot, you don't have much to do there. But I cut my size even more at 750, and then I'm allowed to go back to the original size once I get up above the $500 down. So that when I'm in a negative streak, I cut my size, and then until I'm back in sync and I'm trading in the zone, then I up my size again to make the recovery. I don't believe in that. What's it called? People who believe, there's a word for it. People who believe that if you take so many losses in a row, a win has to be in the cards next. That there's a higher probability of a win coming in. That
based on superstition, basically. Or
it's there's a name for it actually, and it slips my mind. Where the more losses you take, the more likely the winners is in the cards. But that's not how the market works. Well, it's not a stacked deck.
Yeah, if you're bad enough to take 10 bad trades, what I would think that your odds would be that you would take another bad one. Likewise, if you had 10 good ones and no bad ones, I would think the 11th would probably be good, right? Just your batting average. It's like a baseball player. If every time he gets up there and he swings, he strikes out. What's going to make you think, he's got to hit a home run this time? He
He's
struck
got,
out 67 times in a row. We're going to get one out of the park this
you will
time.
be surprised.
Yep.
You'll be surprised what you'll find out there, because people see the market as a closed data set. Like, people will not believe me when I say that the outcome of the very next trade is 50-50, even if you have done a lot of homework and you're trading a setup that over time pays you 90% of the time. The very next trade has a 50-50 chance. I won't get into this topic. It raises hell every time I get into it and talk about it. It confuses people, but it's a fact, because the market is infinite. The only thing you can study for your setup is what has happened in the past. What has happened in the past can, not necessarily, but can represent what could happen in the future. But the fact is, the prices that trade are infinite. The number of ways these prices can trade are infinite. They're like people. The market's made of people, and no two people are exactly alike. We have tendencies, if you throw a swing at me, I'm going to throw a swing back. You would kind of expect that. And the market kind of has those habits because it's made up of people. Fear and greed is what determines prices. But the very next trade is a 50-50. If I told you the very next trade has a 50-50 outcome, you would be really, really, really unintelligent if you risked your entire account on the very next trade. So knowing that you don't know what's coming, the first thing you got to do is manage the risk. Understand it. Okay, I'm going to give this particular trade 2 points, which, let's say in the S&P, 2 points is $100. I'm willing to risk $300 on this trade because I'm trading a $20,000 account, and that's only a small portion of that account for this particular trade. $300 for 2 points, I can trade a 3 lot. Okay, and so you size your position that way, and you stick to your stop. You don't add, you don't do anything funky. You just stick to your plan. If your plan includes adding, then you add, but don't try to pretend. And that's what I was talking about earlier, where people think they're smarter once they're in the trade. You're not. You're in a worse position to make logical decisions when you're in a trade. You have your blinders on when you're in a trade. And so that's why my priority, given my risk profile, my personality, I try to lay off risk. As soon as I lay off risk, I have a panoramic view of what's happening. I can slow down. I can see what's going on. Like I said, I used to trade 1,600 to 3,200 round turns per day. I've probably got millions of contracts traded across a whole bunch of products, and I still know that unless I lay off risk, I'm not going to see things for what they are, because I trade a larger size. And so, just like everybody else, I'm attached to the outcome. I'm not going to control that attachment or try to change it. I'm aware of it. Because I'm aware of it, I'm adjusting the way I trade so that I can go back to being calm and objective. And so I lay off risk early, and then I let the rest of the trade that has already paid for itself, I let the rest of the trade kind of run its course until the market says, no, you're not going to get any more, and it goes back to my entry and I'm out. And so, there's a lot of detail that goes along with that, and there are tools that we've developed at Vancar that help you with that, like the Trade Analyzer. It helps you live. I use that where I look live to see what my actual risk is. What price is my risk at? And it has nothing to do with the average price shown on your dome. I hope I didn't lose everyone on that one, but there's just a lot you can do. And notice I haven't talked about setups. I haven't talked about which moving average goes over what. I didn't talk about which line I trade at, because none of that stuff is important until you get your head on straight. I promise you that. If you don't understand risk and psychology, it's going to be very hard to execute the best laid plan out there.
Good stuff, man. Yeah, I can kind of, and I think you're right on that, because you can have a roadmap, and there's many roads that go across the country. You can take any interstate or any particular route or whatever to get to from point A to point B. But as soon as you start the engine and you get out with the traffic, if you completely run into the guardrail or into the ditch or off the edge of the bridge, then you need to figure out, hey, what you're going to feel. You need to know what it's going to feel like when you're out there in the live environment. You want to know what the wind is going to feel like. You want to know what happens when the cars are honking at you. You want to know about all that stuff. And a lot of when people start trading for real, all that goes out the window. It's like you said, it's like you have your blinders on, That's very, very good information, man. And it's so true. And I know everyone agrees with it and they understand it. But then again, it's easy to talk about it, but hard to really practice it in real life.
Yeah, because people think it's about your entry, your stop, and your exit. So give me the information. I'm going to pay $1,000 to give me a system that gives me those three components. But one of the things we do is automated trading for investors, letter direction business, automated black box type stuff. You might as well just put it, if I'm going to sell you a system that has an entry, a stop, and a target, you might as well just take your money, put it in a computerized system. Why are you bothering with this stuff? The issue is not the signal. The issue is the person executing the signal not being able to stick with and maintain the plan. That's the key element here.
It's so true too that, and this happened to me. I'd have a whole bunch of great small quarter point, half point, maybe some 1 point gains, and then wipe it all out. A whole day's worth of trading gains, with one bad trade. So you have to have some. I've got a bunch of private messages here, by the way. I got people asking me about stops. Do you have like a certain hard stop on every trade you make? Do you look at technical indicators to where you place your stops? Do you have two types of stops where you have one that's a technical indicator, and another one is just an amount limit that any trade can't go past? I mean, can you talk about stops, because obviously that's going to be an important part of taking the emotions out and keeping the account under control.
My stops are generally dependent on the setup, but what I recommend for most people, and what I'm doing with clients and what I've done with my traders, is at the beginning, until you're consistent, you need to peg something down. So let's talk about this for just a couple minutes. If you were on a raft and you're in the middle of the ocean, you can't see any land, the thing you have to do is establish some sort of a firm baseline, right? So you have to establish a point that is anchored or that is steady. And in that way, wherever you navigate from that point, you have a frame of reference, right? That's what you'd have to do, right? If you don't know which direction you're pointing, it's just a great big ocean. You don't see anything. And what sailors have done in the past is use the North Star, right? That's a fixed point. Now, if the North Star moved every night and you're moving on an ocean that has waves and tides and so forth and crosswinds and so on, then you'll be completely lost. That's how people trade. And so you have to peg something down. And if your entries are discretionary, then you can't peg that down. So if your entries are based on some, like pivot point levels or something like that, it's a discretionary entry. It's not an automated entry. So you can't peg that down because you're clicking the mouse to enter. What you have to peg down then is how you control or manage the trade. And so what I say to people who are still or struggling with consistency, create an automated strategy. Like in the VK Trader, you can create an automated strategy with 3 targets or 2 targets and a trailing stop or whatever. There's just a whole huge combination of things you can do. Whatever you do, though, execute it mechanically so that as soon as you enter, the system goes out there, throws your stop out, throws your scale out, to cover risk, and then your targets. And in that way, what you can do, and I suggest they do this in sim, pick your normal trade setups, use a wide stop, like 2 points, take a target of 2 points, and then take a scale out of 2 points and set some mechanical target. And then do it consistently over time. So try to gather 30, 40, 50 samples based on that strategy. So that way you know that your entries is random or your entry is discretionary, but your execution is fixed so that you can study. You can't study your entry if your stops change, if your targets change every time, because you don't know if your targets are too wide, too narrow, is your stop too wide, too narrow, if your entry is also random, right? So you have to do one or the other. If you want to test your entries, you got to execute them mechanically. If your execution is mechanical, then you can manage your trade discretionarily, and that the entry gives you a frame of reference so that when you're studying your trades later, you have some frame of reference to understand what you're doing wrong. So where do you place stops? I For most people, I tell them use a fixed stop. Use a fixed stop, test it, see how often you get hit on that stop, widen it, see how often you get hit on that stop, widen it until you get to a point where you still get hit on that stop, but you have a chance at getting your target, And I can't cover that now. There's a logical way to do this. I can't cover that now. It's a lengthy conversation. Maybe we could do another conversation about it. But you have to peg something down. Either your entries have to be hardcore automated type entries, like you just will never miss a signal, or your trade management has to be mechanical. One of those has to be mechanical until you get to the point where you're trading more intuitively and can then change things around and still be able to manage the outcome of changing those things around. Does that make sense, or did I lose everybody on that?
No, it's good stuff. It definitely made sense to me. I got some more questions here.
Sure.
Trader Gas has a question, and this is something I've noticed too. He says the ES seems to trade differently or behaves differently than like the NQ. And have you noticed that? And he says that he's heard that the ES itself has more high frequency trading in it, and that might be the reason.
Okay, high frequency trading is the excuse for a lot of things. High frequency trading describes um, automated systems that enter and exit the market or play, the bid offer game at very low latency, nanoseconds. Companies will spend 20, $30 million to squeeze another 80 nanosecond out of their execution. Unless you're a trader that's scalping like crazy, like I used to, it shouldn't affect you. HFT doesn't affect you because what HFT is doing is it's either playing the bid offer market, automated maker game where being queued first is the key to the game, or it's doing an ARB against the spiders, against the S&P pit contract, or some option play or something like that. It's doing it at a very high frequency. It shouldn't affect your game at all. What affects how the S&P trades versus the Nasdaq is the components. In the end, when you're trading the S&P, you're trading an index made up of 500 stocks. How are those components behaving? What portion, if I ask somebody here, what portion of the S&P 500's market cap is run by technology? Your answer should immediately be 27%. 27% of the S&P 500 is run by technology companies. What portion of the Nasdaq 100 is run by technology companies? I haven't looked it up recently because I don't trade the Nasdaq that much, but it's a lot higher. And so if Apple happens to be the heavyweight today and is moving the market, then the Nasdaq's going to move very different than the S&P. I keep a chart. I keep a 15-second chart on my charting on my monitors that creates a percent change line starting at 0 when the market opens at 9:30 Eastern. And it has the Russell, the transports, the XLF, which is financials, the XLK, which is the technologies, NASDAQ, Dow, DAX, Euro stocks, all these, the main indices around the globe. And it shows me which one is stronger, weaker, and so forth. And I use that as a, big picture gauge. So, depending on what's running the stock, the market that day, the product's going to react, and it reacts differently at night or after, the cash session after 4 o'clock than it does between 9:30 and 4. I don't trade after 4 o'clock because basically the S&P starts to become a proxy for what's going on in Tokyo, then what's going on in London, and what's going on, elsewhere. It doesn't trade its real price, which is set by the 500 stocks, which don't trade at night, or at least not on much volume. So it behaves differently at different times. Most of the volume of the S&P happens between 9:30 a.m. and 11:15 in the morning, and 2:15 p.m. and 2:15, no, New York time, it would be 3:15 p.m. to 4:15. That's where the highest volume happens. And the stuff that happens in the middle of the day is local. It's what's called local to local. It's not stuff that pushes the market one way or the other in the long term. It's locals trading against each other. So it changes. What I'm trying to say is the characteristic of one market to another changes from day to day based on what sector is kind of pushing things around. It's changing day to day based on news, geopolitical events, and then it's changing within the day. It's changing from time to time based on what time of the day, what time our institutions or what we call paper comes into trade to do its business for the day and to square up its books at the end of the day. So it's constantly changing. Does that affect how you trade? Does that affect how you manage risk? It does, slightly, but not that much. Does that answer your question?
Yeah, I think it does. I guess it thanks. So if another question came to mind, if let's say someone works a regular job during the day and they can't trade, and either they're gonna trade and not do their job, or how that is. But let's say they can't trade during the normal market hours, like regular, 9:30 to 4.
Mm-hmm.
What time frame, if they had to trade the futures after hours, would you say would be probably the most predictable or most productive if you had to pick it? A 6 hour or a 4 hour. What would you say would be the best well behaved time periods?
So for me personally, because I grew up as a futures trader trading the European markets, it would be the 2 a.m. 2 a.m. to 4 a.m. Period. Just because Europe kicks in and it swings a very, very heavy rope, around the world.
Right.
But there have been moves that happen at like 7 p.m. to 9 p.m. or something like that. But that's generally, the Tokyo session really is not that active. But here's the thing: pick something. Pick something. It doesn't matter what it is. It matters to a certain extent. You don't want to trade the 4:30 till 6 p.m. portion of the day because nothing happens there.
Mm-hmm.
But pick something where there's a major market open. So when Tokyo opens, for example, and just study that. Just become really, really good at that. Other than being undercapitalized, not understanding risk, not having a trading plan, the next thing that really screws people up is that they're constantly changing. So that's part of trading randomly, where they trade something until it doesn't seem to work, then they trade something else until that doesn't seem to work, and they spend very little time perfecting anything. Become really good at one product. If you're somebody who's trading, like I see some of our clients will trade the S&P, the Nasdaq, and the Russell, and they suck at all three. They have no business trading all three. Pick one, get really good at it, and then it becomes really easy and generally a successful endeavor to add a second market. So how is this related to this question? You pick a certain time slot where you will never miss that time slot. You'll study for that time slot. All of your volatility, volume studies, range per bar studies, whatever it is that you're doing, it's based on that time slot. When that time slot happens, find your edge in that time slot. When the edge happens, take it. Control your risk and take it. But stick with a time slot so that tomorrow you're not trading the open, then the day after that you're at lunch, trading lunch, then the day after that you'll trade that time slot. That you're never gonna perfect anything. It's a lot like somebody who's trying to be a great NASCAR driver, but every once in a whatever chance he gets, he gets on a dirt track, and then he gets on a motocross bike, and then he gets back on the tarmac, and then he street races. You're never going to be good at any one of those things. You want to be a NASCAR driver, you drive a freaking NASCAR. You make a time to do it. You do it always on the same track at the same time until you've perfected it. Now you can go out, quit your job, and do that particular thing wherever you want, and you'll probably have a much higher chance of success.
Good one, man. That's a good analogy. A NASCAR driver, turn left. Get good at that.
Yeah, that's right.
Leave Formula One alone.
Stay away from the concrete wall.
Yeah. Yeah, buddy Dak has a question for you.
Hey, Dak. It's been a while.
He's out there listening. And he says, "Can you just go through in the morning? How do you mentally prepare? And get set up for the day in the mornings?"
So there's like a homework routine that that I've just I've done it for so long, but generally I recap the day. Usually around market closes at 3:15 here in Chicago, and I recap the day at about 3:30. I generally get up, do something, walk around, whatever, come back, recap the day, write, do my journal entries and stuff, and then I look at I answer some main questions. What have we done? What are we trying to do? How good of a job are we doing in getting there? Whatever we're trying to do, and what is more likely to happen from here? Those are the questions I have to answer to prepare for the next day. What have we done? What are we trying to do? How good of a job in doing that? And what is most likely to happen from here? Most likely, not what's gonna, what should, what needs to. No, we're traders. We trade probabilities. Nothing is known. We trade the unknown. We're on the hard right edge. So those are the 4 questions I seek to answer from my homework. And then the homework consists of checking the calendar first to see what's in play from a macro to micro perspective. Then I pull up a chart that shows me how value has moved over days. Then I zoom that out to see what has happened over weeks and months. And then I come back into what I call the composite, which is a chart that shows where the volume has traded or what the market has done over the last couple of weeks. Then I start to look into the last few days. Is the market in balance or is it out of balance? Is it trending? Like today was our first rally day in a while. The market's now going into balance. It's more likely to float upwards from here just slightly, but it's in balance. It's going to balance. It's rotating around, snaking around itself. Okay, it's no longer trending, lower highs, lower lows. So now going into tomorrow, my perspective is going to be, the question I have to answer is, are we going to trade in balance tomorrow? Are we going to trend? and I'm going to look for signs for that. I come up, by the time I'm done with the homework, I have 3 hypotheses. Just like a lab technician would, they would write down and say, my experiment is going to be to find this out. And they'd write down their hypothesis. And then the market tells me what the answer is. I never impose my thoughts on the market. The market tells me what it is. This stuff is covered in webinar 4 on my website. So once I get the 3 hypotheses, and 3 hypotheses are based on 3 simple things. What will I do, and what am I going to expect if the market opens in range, in value? What am I going to do? What should I expect if it opens above range, above value, like yesterday's range and value? And remember, I only look at the day session. What will I do, and how will I react, or what will I expect if it opens below? That's it for the afternoon. I answer those 3 questions, I'm done. Or 4 questions and come up with these hypotheses, and I'm done. Then the next day I come in and I look at what happened overnight. What did the Asian session do? What did the European session do? What things came in? I check the news feed and look at what has happened. I'm not a fundamental trader, so I don't put too much weight on that, but it gives me an idea of what sectors I should watch for and things like that. And then I add 2 more hypotheses. Now, how far are we from, now that I know where we're likely going to open, what's going to be my play going long and what's going to be my play going short? If we're opening below yesterday's range and value, then I have a plan for how to trade it back towards the range and how to trade it away, going away, trending away from the range. So I end up with 5 ideas on any given day. Sounds complicated, but it isn't. And then after that, with every one of these ideas as I'm doing them, I'm actually visualizing them. I can almost take the screen and draw an arrow describing how I expect it to play out. And I've posted some of these arrows, some of those screens on Twitter and in the futures room, where, is this going to happen or is that going to happen? And just visualize, what will it look like when it's coming to my level? Just close your eyes. What will it look like based on my experience when it's coming to my level? And if I'm going short, what will it look like once I get short? What should I expect it to do? Just visualize it, and then you're ready to go. Then I'm confident, and I know my homework by heart, and I understand the story that the market's telling us, and every price tells a story. And I just let it rip. When the market comes to my area, come hell or high water, I'm trading there. Unless, of course, news or some volatility comes in and I don't understand why, or I feel like something has changed my perspective on the market. I'd rather be flat than take a trade that I feel completely not confident about. But in general, if the market behaves the way I expect, I'm in the trade. I'm going to take the trade, and I do that live with clients. With our clients, I'll fire up GoToWebinar, and I'll just go over the homework, and I'll just say, "Hey, approaching our area," and you'll hear the fills. You'll hear my trading platform get the fills, and I'll tell you exactly how I'm managing it. So, I'm not sure if that answered your question, Dak.
Yeah, it should have, but Dak is he's slow. No,
Come on, he's a nice guy.
He's a great guy. He's a good friend. It's a good thing. He says thanks. The good thing is too, this is being recorded, so all of us can go over this stuff. I'm looking at his private messages come at me. He's going off on me now. That's funny.
Nice.
Payback's hell, right, Dak? You got to remember that text message, that picture you sent me while you guys were celebrating John's birthday. They sent me made me want to be there, and they sent me a nasty text message. Anyways, you'd have to have seen it. It's funny. Let's see. I've got some questions that have kind of come up that I think would be good ones. Do you trade this particular day? Do you trade differently based on the type of volume patterns that you're seeing? Like if it's just a really low volume day, is there ever a time when you just decide you're not going to trade at all? just sit on your hands, or is there, or do you, or unpredictable spurts in volume? Does that kind of like just get you say, I want to just back off of this, or, how do you got enough experience? You definitely have seen all
Well,
different types. So
yeah, I love volatility. Give me a market that's whipping around and with a 40-point range, and that machine is going to sound like Star Wars battle scene or something, with the laser sound that I use. Um, I love the volatility, but I tell you what, to answer your question, I'll ask you one. Um, why would the market have low volume and it chops around? What condition would create that? Why do you think it would do that? Just
um,
think of the market as a pricing mechanism. It's
right,
an auction. It's an auction, right?
yep.
Why would it go sideways on low volume and chop around?
Well, I mean, if there's,
Any guesses?
yeah, I'm just thinking that you mean chop around, or you mean really super sideways consolidation? You mean literally a lot of
Yeah,
chop?
super sideways consolidation because that's what happens on low volume, right?
Right, right. And it's just people trying to get what they can out of a very small amount of moves, and it's not a whole lot of big movers moving it up and down in larger swings, right?
Right. So why wouldn't they move it up and down on large swings? Like why would that happen, you think? Just throw hazard a guess, throw anything out.
Yeah, I'm waiting. I'm trying to read. Uncertainty, as Mr. Investments is saying in his chat room here. Um,
Uncertainty, um, the other way to look at it is um, the market has already priced in the information that it has, right? So if it's already priced in information that it has, then it's got nothing to do. Volume and price move together. Not, the market doesn't attract volume because price moved or the other way. The fact is, price and volume are the chicken or the egg. Volume comes in and it moves price aggressively, or prices move enough to attract more volume. As in a sell-off, it gets to a point where it starts to bang, hit a stop, which leads to another stop and another stop.
right.
And now you have transactions. The volume coming in and out of the market are transactions. If I'm holding a stock or a futures contract, and as far as I'm concerned, nothing has changed to cause me to change my position or close it or add to it, then why would I touch that position? And so when you have sideways chop on light volume, the market's imbalance. And so I always have a plan because the market can only be in two conditions. Either it's balanced or it's trending, also called imbalance.
Hmm.
And so as long as I know what condition the market's in, I have a plan for that. I have a plan for when the market's balanced. I have a plan also for when the market goes from balance to imbalance. Generally, it involves me getting stopped out. But if the market's going sideways on light chop, essentially what you're doing is the market's saying, I've got nothing to price in here. This is the fair price here. For everything that we know, Greece, Spain, whatever, I'm already priced in. There's nothing for me to do. And so on those days, it's local to local trading. You'll actually hear Ben say, it's local to local trading here, folks. Nothing's going on.
Right.
Paper's out of the pit. Blah blah blah. That's where people get absolutely chopped up, and brokers make a lot of money. It's that you start to read price action. Oh, it made a higher low and a higher high last time. Let me get long, and the next thing you know, it makes a lower high and a lower low, and you think, oh, the trend's changing, so let me get short, and then it makes a higher low and a higher high, and you're getting stopped out 3-4 different ways because you're flipping a position. On balance days, I look for my edge is at the extremes. I'm looking for the price to move far enough out of balance for me to hammer it back down into balance. And on trending days, I'm looking for either the break out of balance into a trend, like the market compresses and a lot of energy builds up that causes a strong move in one direction. That's why I use volume profiling. I've traded Bollingers, RSIs, Fibs, Stokes. In the end, to me, it's all about price and volume. That's why I use a volume profile. And a volume profile will show me that there's a whole crap load of energy. In other words, the market has traded, 800,000 contracts in a 3-point range. Something's going to break. So many people have taken positions in that tight range. Somebody's going to be wrong. Someone is going to be wrong. And I don't know who, because you know what? I'm a professional trader. I'm profitable. I've been consistent for a long, long time. But I still will be the first to tell you, I don't know. I don't know if it's the shorts that are going to win out and they're going to blow the longs out, or if it's the longs that are going to squeeze the shorts out. You have to look at a bigger time frame to figure out who's got the upper hand. But I'm in a position to take advantage of that. So on light volume days where there's chop, I'm just looking for an extreme, for the market to reach an extreme so that I can hammer it the other way. And I keep my targets very modest. I'm looking for 1.5, 2 points. I'm not trying to scalp, but I'm looking to lay off my risk real quick. On trending days, you put it on, you let it run, and you keep runners on, and you just let the market carry the position as far as it wants to go. And there's ways to measure what quality trend you have, what quality balance you have.
We had I forget when it was. Was it Friday? I guess we had one of those days where we were just trending down. I mean, it was just selling, more selling. It had a couple of pops, and in there 1 or 2 point pops, and more selling. I mean, do you find yourself, when you realize that the day is going like that you just put your shorts on, you let them ride, or are you tendency to like wait for a setup for a bounce, or do you try to catch some of both?
I can tell you, I can be upfront and tell you that my worst days are trending days, because I'm a value trader, and I'm a fader. I know that about myself, and so I know that trend days are generally not good for me. I will catch them fairly often. I will catch a trend and just sit. But in general, trending days are not good days for me, because I either sit on my hands because I didn't catch anything, and I'm not going to buy price that is way, way, way far from value.
Right.
Or I'll still trade the homework that I did. But generally, the areas I do homework are edges, and I do get relief. Like even though it's ripping down, in the areas that I want to trade, it generally gives me a point and a half counter rotation, and that allows me to lay off risk and keep a stop 1.5 points below my entry.
Right.
And so that if it continues down, the worst I could do is, in most cases, is scratch the trade, use the profits that I booked to finance or fund the stop loss that I have. But in the S&P, how many days does the S&P trend on average in a given year? What percentage of the time, historically, does the S&P trend?
I don't know. I'm sure you would know.
18%. I'm willing to lose. I'm willing to risk being wrong 18% of the time. And that's what my daily loss limit is. I guess Vester, someone who's done a lot of homework. I know who Stang is. But I'm willing to take my chances and lose on those 18% days. So I don't mind. Days like Friday, I don't mind. Although I left early because I have family in town, and I was up when I left, I saw that it broke through pretty much all the levels that I had with about a 2 point counter rotation as it did that. So trend days are not so good for me.
And yet, if you could go back in hindsight, So, wow, why didn't I just put 10 on here as a short? Look
But
at
where? But
it's like
where?
where?
That's the
It
problem.
won't stop. It
Yeah, but
just
the problem is like, where do you put those 10 on, right? I mean,
right.
it looks great. The problem, as traders, we have a very uh, problematic issue with trading, a very big caveat with trading, and that is we're trading on the hard right edge.
Mm-hmm.
Everything looks good to the left, but on the right side of the chart where the unknown, exists, I don't know if this pullback is a pullback or if it's a reversal. What if you get a V-type reversal and then news follows 30 seconds later?
Mm-hmm. Yep.
I don't know. But like I said, the only thing you can do to protect yourself against this stuff is have a plan. Have a plan that trades a trending market, have a plan that trades a balanced market, and stick to your plan. Stick to your guns. Take your chances. As a trader, you cannot live or die by the next trade. If you did that, it's incredibly stressful. It is just a dismal job. It is just a horrible job to have because it just looks like endless losing all the time. You'll have a lot of fear, and it's a waste of your time. You could probably take that money and do something else with it. So as a trader, you're trying to protect your right or your ability to trade many, many times over the next few years, because that's the thing that's going to take you from the few who succeed, take you from the many who cannot succeed in trading because of the issues outlined earlier, to the few who can, because the few who can have the discipline, have the commitment and determination to do what they need to do. Most people don't,
What's
Most
it like?
people look for solutions outside.
Isn't it like 5% of traders um, are successful or at least profitable, and then the other 95% of the ones lose their money?
Yeah, there's numbers thrown around. I can't quote any because I'll have the NFA breathing down my throat. But
Mm.
I've never done any studies to know what it is. But like I can tell, I'll talk about clients. I can see where clients came from. They came from, our competitors, and immediately they trade in a way that tells me that they're uninhibited and they have the wrong idea about the market, and they probably um, are going to blow out. And then as soon as I intervene, as soon as I give them that call, pull up their name, give them a call, and start saying, "Hey, this isn't going to work." Um, their behavior changes. They have a better chance because all I have to do is give them a better chance is to just slow them down. If I can take you, let's say you said you did that live trading, 3 sessions of live trading. Is that right? I think you said it was
Yeah.
3 sessions.
Yeah,
You
I
made
did.
money in two, lost money on the last.
Yeah.
All I would have had to do if you worked for me and you're a prop trader, all I would have had to do is allow you to lose on that last session, but my job was to slow you down. Losing is not bad. It's part of the business. You have to lose to learn. But I would have slowed you down so that you would have lost it over 10, 20, 30 trades and gained the knowledge from that loss, gotten more comfortable. You can't learn how to drive, which we do with our left brain. It's logical. I got to do this. I got to check the mirror every 5 seconds. I got to turn. I got to use the signal. You can't learn how to drive if you're just sitting in the driveway pretending to drive. You've got to go out and drive. And the more you go out and drive, the more intuitive it becomes, the better driver you become, right? And so you have to have a large sample of trades to be able to understand and finally get that fuzzy feeling that explains what trading is at its core. Unfortunately, I can't throw a percentage out. The overwhelming majority cannot stay in this long enough to have that, to get to the point where they see that.
I think they get out on the road and they floor it and they wind up in a head-on collision, and then they never
Yeah.
drive again.
They hit a concrete wall and then they can't drive they can't drive anymore. And my job is to slow you down and keep you inside of the lines on the highway.
You
That's
might
my
get some
job.
dents and some bruises and some flat tires, but the car will still run.
But eventually you'll understand. Oh, okay. I need to look down the horizon. I can't stare at the little the front of the hood.
Yeah,
if I
yeah,
want to go straight.
right.
So anyway,
Lots of good analogies.
I hope this has been helpful for you. I need to drop off, but
Okay.
again, I hope nobody expected to talk about setups and so forth. I caution anyone to take somebody else's setups and try to trade them. I can say without a doubt that that is not the way to make it. The way to make it is to acknowledge and understand your emotions, to put a plan in place, and the key element, risk, control, risk. The difference between me and the guy who's losing money that I'm trading against is that he doesn't understand risk. He has not defined risk. I have, and I've traded long enough and enough times to have a healthy respect for it.
Good stuff, man. It's probably one of the best trader spotlights I can remember in a very long time. Packed full of information, and the thing about everything we've talked about tonight, everything that you've shared with us, is stuff that it really can encompass. All types of trades. All everything, and it's probably the most important thing that. The most important things we need to try to master. And then, like we were talking, everybody has their own technicals that might work, or their own, set of technical or whatever, that in theory can work, but they can't put it into practical use because of the emotions and everything else and the risk and all is not understood, and they wind up crashing and they give up. So
yeah, if with the right risk controls, you can flip a coin and still get a decent percentage. In fact, I've proven to clients by doing an exercise that we have that a coin flip actually beats their setups as far as the percent win, as long as risk is under control. As long as they take the loss and keep it small, a coin flip actually beats their win percentage.
Wow.
So that's how important risk is. Anyway, for more information on this stuff, there's plenty of free archived videos and a blog on my website. It's not it's all there. Browse at your leisure. You don't have to pay for anything or buy anything. I don't want to sell you anything. And then for information on the brokerage, our banner is that yellow banner under the day trading radio video. It's the yellow one that says, "Can your broker do this?" Click on the banner and ask all the questions you want. Our brokers will get back to you. And our goal is to change the way the industry operates, and it starts with each and every client. So I appreciate you listening to this, and trade successfully.
Thanks so much, man. Really appreciate it, FT.
All right, have a good night.
All right, take care, man.
Take care.
All right, so that includes an awesome Trader Spotlight Live. And I would mention too, the futures here, as you can see, 13:15 right now, and it's right here about 37 minutes after 10 p.m. Eastern. And thanks everybody. I see everybody in the chat room saying goodbye, and thanks to FT71 one more time for his great knowledge and sharing that with us. And again, futurestrader71.com if you guys want to check out that. And then again, vancartrading.com is the banner right there underneath the Day Trading Radio video. And I'm RPM, of course, and this has been another Day Trading Radio's Trader Spotlight Live. And yes, this has been archived, and if you guys are watching it from the YouTube channel, we appreciate you listening too. If you're not a Day Trading Radio Premium member, you guys really consider it. Come on into the Day Trading Radio chat room. You can talk to all the great traders, and of course FT71 is part of Day Trading Radio now. You see him in the chat room as well, and you can hit him up, send him a private message, or just watch a lot of his posts during the trading day in the futures room especially. So it's good to have him around, and I hope make it a very long relationship. Obviously extremely experienced and bright trader, willing to help, and that's what we need, and that's what Day Trading Radio is all about. So with that, everybody, I'm going to go ahead and call it a night. We appreciate you listening. Take care, everybody. Good luck in the markets. We'll see you. RPM out.